it's important to consider that cost of living in the context of the yield paid on savings products. Doing that, if you buy the so-called riskless product, the US 10-year Treasury, and get paid 4.25 in a currency that's losing purchasing power at 7.5, rather than making 4.25, you're losing 3.25 in purchasing power annually. And I think that's the circumstance that investors came to see in the middle part of the decade of the 70s, which is why we had an absolute rout in the long bond and an absolute explosion in the gold price. I think that's what's in front of the Fed today.
Did you know that holding cash could actually be eating away at your wealth? With the US dollar losing purchasing power at 7.5% annually, Rick Rule highlights that even so-called riskless investments, like the 10-year Treasury, yielding 4.25%, are actually costing you 3.25% in real terms. Over time, this erosion in purchasing power can severely impact your savings, leaving you with less than you think. Rick Rule draws parallels to the 1970s, when similar economic conditions led to a bond market collapse and a skyrocketing gold price, signals we could be seeing again today. He explains how the real problem isn't the rising prices of goods, but the declining value of the currency itself. If you're relying on cash or low-yield savings, you could be losing more than you realize.
I suspect if the Fed wasn't in place, if you had a deregulated credit market, which is to say, if you had a market in money, a market in credit, that the interest rate would be the real rate of depreciation of the US dollar purchasing power, which is to say 7.5%, plus a premium for risk. If people are concerned about high housing prices, that would certainly fix that. Imagine if a first mortgage was 10%. Imagine if the prime rate of interest was 9%. Imagine if consumer credit was priced at a premium to prime. Will we get there? I don't think so. And I think that investors need to focus on the delta between the yield on savings and the depreciation of the purchasing power. I do. I think that the U.S. has a stronger economy than people believe, but it's a two-tier economy. For people like me with access to credit, artificially low price credit, and the knowledge of how to deploy credit, this is the best possible economic environment. This circumstance is tailor-made for a guy like me. But most of the economy isn't made up of people like me. Most of the economy is made up of people who only have access to consumer credit, which is to say they're paying 20 or 22% on their credit cards, and they're close to maxed out. They're using credit to sustain wants as opposed to needs. They aren't using the credit in a credit arbitrage. In other words, using that credit to make more money to service the debt. And I think the chickens are actually coming home to roost. The problem with the level of pricing is not that goods have become more expensive. It's that the medium of exchange has become worth less. People don't seem to get that. While wages have been increasing, they haven't been increasing anywhere near as rapidly as prices have. When you look, as an example, at in my area, the functional minimum wage is $20 an hour. You can't get people to work for less than $20 an hour. You and I think about $20 an hour in the context of 20 years ago. But the truth is, if you make $800 a week, $3,200 a month in this market, you almost can't afford to rent in this market. So this so-called princely wage of $20 an hour compared to the statutory minimum at 7.5 or whatever it is, still doesn't constitute a living wage. And I think that dichotomy is increasingly impacting the consumer's ability to finance, to sustain the lifestyle that they would like to sustain. And I think that will yield financial and social problems. Now, the truth is that there have also been demographic forces and NIMBYism that have forced up the price of real estate. Real estate might not be descriptive of the broad market, particularly because of subsidized credit in real estate. And also in certain markets like Vancouver, British Columbia, uh, because of the extra fees imposed on developers in development fees. There are certain jurisdictions in North America, Vancouver being one of them, as an example, where the construction of a rental unit involves incurring $200,000 worth of upfront fees before you buy the land or pound a nail. So there may be special forces around housing, but most of what you say, which is to say that the price of goods hasn't really increased in a real sense. The nominal value of the medium of exchange has declined. You know, I look at a lot of things. I do a thought exercise a lot where I value things in gold uh, rather than in US dollars. And if you have been, like me, systematically investing in gold, not enough in retrospect, for 24 years, what you're what you're struck by is that the price of many consumer items that you go to buy in gold terms has gone down, not up. So the problem is much more the denominator than it is the absolute level of pricing. And investors need to consider that in terms of how they organize their savings in the future. I don't think it's early. Let's talk about those names respectively. At my conference a month ago, I had the extraordinary good fortune of having lunch with Sean Boyd, the chairman and ex-CEO of Agnico. They have outperformed the sector because they have outperformed the sector. It isn't just the share price. They've allocated capital well for 20 years. They've lowered their all-in sustaining costs. They have a wonderful development pipeline. This is a company that you would buy if they manufactured plastics or sold hamburgers. They outcompete others in the sector, and they will continue to do this. Uh, the market has become rational. They're asking gold mining companies to be efficient mining gold. Imagine that. You're supposed to be good at your business as opposed to merely being a proxy for the higher gold price. With Newmont, their all-in sustaining costs have been distressingly high. The market here is speculating that they will do what they say they're going to do, which is to say sell off all of their tier two assets, improve their balance sheets, and utilize that capital and love, care, and attention on their tier one assets. If they do that, I'm not saying they will, I'm not saying they don't. If they do that, what you've seen in Newmont is just a down payment on what's coming in the future. Barrick has done a better job with AISC, but people are concerned about Barrick's growth strategy, particularly the decision to deploy capital into copper and in Pakistan. I happen to believe this is a good thing, but time will tell if I'm right. I would urge the people listening to this conversation to own gold stocks. I would urge them to deploy into the higher quality names before they indulge their fantasies with the alpha, with the penny dreadfuls. I'm not saying not to buy the penny dreadfuls. I'm saying to invest before you speculate. If you believe in higher gold prices and you believe consequentially in higher operating margins around gold producers, remember it's important that they produce. Remember, too, the lesson of the decade 2000 to 2010, where the gold price went from $256 an ounce to in excess of $1,800 an ounce, a seven-fold increase in the gold price, and free cash flow per share on the XAU fell. It took real skill to screw up a bull market like that. So make sure when you allocate capital to the gold mining sector that you impose the same discipline on the companies that you would in other sectors. And I'm not saying not to come down into the speculative ones. I love to speculate. It's treated me extraordinarily well, but I work hard. So don't come down into the sector if you aren't prepared to read 10Ks, 10Qs, proxies, management information circulars, and resource statements. If you aren't prepared to do that, stay with the biggies and stay with the best of the best.
Thanks for tuning into today's video. Let's quickly recap the key points we covered. Rick Rule emphasized the critical impact of inflation on your savings, showing how holding cash in today's economy could actually be costing you more than you think. He highlighted the importance of understanding the real value of your investments, especially in a time when the purchasing power of the dollar is eroding faster than ever. We also explored the significance of gold as a hedge against these economic challenges, and why it's crucial to be strategic about where you allocate your capital. If you found this discussion insightful, make sure to subscribe to the channel for more in-depth analysis and financial strategies. Don't forget to hit the like button if you enjoyed the content and share your thoughts and questions in the comments section below.